Hey everyone, welcome to Verivest webinar. Today we have two special guests. Matt Burke is going to lead it off, and here we go. Thank you.
Thank you, Kylie. Yeah, I'm happy and excited today to have a couple of guys that I've known for probably the last 6 or 7 years or something like that. Met in person a number of times, and they have a fascinating model that I think people will be very interested in. So today I'd like to welcome Pedro Reynoso and Gabriel Gonzalez. And guys, thanks for being on the show.
Thanks for the invite, Matt, and thanks to the audience. Happy to be here with you.
Gabrielle, welcome. Thank you for being here. Where are you guys Where are you guys at today? Are you in Mexico? Or are you down in Texas or what?
Well, I'm currently in Mexico City. I split my time business-wise between Mexico and the U.S., mainly in Austin, Texas. But yeah, today I'm calling you out from Mexico City.
I'm in Austin, Matt, where our main offices are of USR Investments. But as Pedro saying, we split our time between the US and Mexico. I mainly on Monterrey, Mexico, a northern part of the city in the northern part of Mexico, and Pedro down in the capital, Mexico City, where we have the bulk of our investors.
Yeah, well, that's a great place to start, guys. I know that when we got introduced, Pedro, this is a number of years back, and I want to say it was from you were participating in what would you call it, an allocator kind of an environment and asking around, and they introduced you to us and we got to know each other. And I actually was down in Mexico City back in January, and Pedro was kind enough to show me around and some of the sites and so forth. Never been there before, so it's fascinating. But I know you guys, you guys are from Mexico, get your roots down there. Maybe you guys can give us a little background on your story and kind of how you got into the real estate business. So you're in the mortgage business, development business, but why don't you give us a little background on you guys?
And I'll kick it off, and thanks, Matt. So Gabriel and I have been friends since kindergarten. So we've known each other most of our lives. We've been close. We're godfathers to each other's kids, and we each took different paths after high school. And I went to college in the U.S. at Colorado School of Mines, and then got a degree there, came back to Mexico City and worked another degree down here and started working down here in real estate. Basically, I've been in real estate development, mostly single family and apartment complexes most of my life. Back in the early 90s, there was an opportunity here in Mexico. We identified the fact that mortgage banks had disappeared in the 1970s. So with a pool of investors, we started a new small mortgage bank that was a lot of fun to work with for about 10 years, from about 1994 to about 2003, middle of 2003. And that mortgage bank was a very interesting opportunity to issue all kinds of bridge loans to developers. We'd always been developers, but now issuing loans to developers. Not only that, but also issuing the individual mortgages to workforce housing, which was, a great experience. That business had a very, very successful run for about 10 years with a CAGR about 30% year on year. And, we had a successful exit in 2003. After that, I went abroad.
And then Pedro, hey, before you keep going, so is that all? Just a couple questions. That was all down in Mexico, is that right? You're doing
that mortgage bank. All this that I mentioned is all around nationally around Mexico City. And in 30 states, actually, basically every state of Mexico, we had operations where we were either lending money for bridge developments, or we were actually issuing individual mortgages. So that was traveling all around the country and issuing loans.
Yeah, that'd be an interesting conversation unto itself, just to like, how did that work back then? I mean, I know in the States, I mean, I've run mortgage banking companies, and you're selling paper off to securitization. Are you funding that paper? Did you have a fund? Like all of that. And I don't want to get too sidetracked on that today, but fascinating. So you ran the mortgage company, had an exit in 2003, and then where did you guys go from there?
Really quickly, back then we had the privilege of having working with a first level bank and second story bank. So we were actually all our mortgages were actually already kind of sold, but by the time we issued them, they just had to comply. And it was a government kind of a Fannie Mae, Freddie Mac kind of situation. But after that, an exit and some more studying. And then I started doing some distressed real estate portfolios here in Mexico from our banking crisis in '94. So there was still some assets that hadn't come full circle. And then after that, never stopped really developing and building. But at one point, I think I shared with you, Matt, when we were down here in Mexico, for various reasons, I decided that there were better opportunities in the US. And having known the market and having been an investor, I decided to start doing some more hands-on approach investing and developing in the US. So there I reconnected with Gabriel, who's going to share his story, and we decided to start working together and building what's now USRE Investments that pools and allocates investors. We'll get into that, but for now we're up to date. And now, Gabriel, you're up.
Well, on my side, as a kind of a different story, as Pedro was mentioning, I studied in Mexico. I'm an engineer, and after graduation, after my MBA, I started to work in the finance area. I started in a boutique investment bank in Mexico, one of the first investment banks focusing on private equity and restructurings and M&A in the late 90s. And then from there, I took it on to investment banking, working for Credit Suisse for several years, working for JP Morgan, my last part of the years. And in JP Morgan, something interesting happened that I was part of the opening up and establishment of the REITs in Mexico. Back in 2000, legislation changed, regulatory laws changed and allowed for issuance of, believe it or not, there was no regulation to support REITs and real estate public vehicles in Mexico. And they started, and in that phase, I participated in several IPOs, and I was very involved. I was in charge of the real estate sector in Mexico for JP Morgan. And then there's a story behind why we started our business and why I started focusing on real estate from banking and finance. First, it was the idea that being a banker, you're working all the time. You have to diversify your savings. And we wanted, given the restrictions you have, you can't invest in marketable securities. We wanted to invest in, hard assets as a passive investor, probably, or a direct investor in real estate, having part of your wealth being locked in a real asset that's generating income for your family in case you're no longer, with them. So I started to focus my investments on real estate in Mexico, given that I knew that, Mexico, but we had several, as a family, and meaning my extended family, we had several instances in which real estate in Mexico, given laws and given the insecurity, it was more of a problem than a safe asset. And so that's when we started to look into investing in the United States in real estate. The same we initially did, personally I did, but then inviting investors to participate in real estate in the US.
Yeah, so let's take it. That's a great segue to kind of the next phase, and this is, I think, where the meat of what I wanted to kind of talk about with people. Is I know you guys have done a lot of business in the United States with other sponsors and other developers and so forth. So maybe describe kind of the evolution of what you guys have done, what you're looking for, how you look at deals, what kind of things you guys are after and doing, and describe some of the stuff that you've done over the last, whatever it is, 10 or 12 years since you guys have been here in the US.
Thanks, Matt. So yeah, well, I would start with the other side of the equation, which is we started getting a lot of push from high net worth individuals who we know personally who wanted to participate. So we actually started finding ways to allocate not only our equity, but their equity into successful deal-by-deal operations. That was the very start of it, right? And we started with friends and family, and then we started growing that organically. We actually don't advertise, and we're not, open to the public in the sense that we're mostly an by invitation firm. So that's how we started, raising some of the equity. And then we started looking, realizing that we were going to need to be able to deploy larger amounts of equity. We started looking for the correct sponsors in different strategies that we really liked. And it's no secret to anyone that about 12 years ago, the multifamily business was a very, very interesting asset class. And our challenge there was identifying the correct sponsor who we could partner with, somebody that was in middle market, not the huge guys, not the very small guys, somebody we could actually partner with and then grow together, right? And so the first asset class there would have been more related to multifamily. And then Gabriel, you can probably talk more about that.
Yes, as Pedro was saying, I mean, we wanted we're humble enough to know that we don't know the US market as obviously local players do. So when we started to get a lot of inquiries on participating with our capital in the US, we started to look on partnerships in the US with specialized sponsors, specialized operators, owners of properties that had a good track record, that were specialized. We wanted to focus on operators that dedicate their efforts and energy to one asset class in particular, and having that experience, as I was saying in Mexico, we wanted to start with a low risk profile, and after our initial analysis and our initial investments, direct investments, as Pedro was saying, we started to look at our relationship in the multifamily sector as our first investment with a professional sponsor. And then from there, we pivoted to, although continuing to do investments in multifamily, garden style, suburbs, middle class particularly. And then we started to pivot to neighborhood community shopping centers, a specific niche with another player. And we formed a fund in that space. And then from there, we have pivoted to other asset classes as there is an opportunity and as we study the market to see the supply-demand dynamics on each market.
So I think.
Go ahead,
Yeah,
Pedro.
No, I think just to add a little bit to Gabriel's comment, and he kind of alluded to it. We actually didn't just land on the neighborhood shopping community centers or the strategy we're working more now, that by chance. We're actually looking at the macro and trying to find where the safest adequate returns we can find within the real estate business. So we only do real estate. We're not looking right now to move into anything else, but we are very interested in continually evaluating other strategies, many such that your audience and you, Matt, know well. Like, we've analyzed, self-storage, we've analyzed industrial, and each niche has a lot of potential. Here again, we actually moved or pivoted to that neighborhood shopping community center to diversify, but also because we believe that model was and has proven to be very resilient as an investment class, right? And there, we've moved on to our next strategy. We never actually closed down past strategies, but we do realize when the market becomes over competitive, we're not necessarily going to be trying to stick to the just one strategy and be overpaying, or going in, guys, you probably know, a negative carry. We try never go into negative carry, for example, if we can avoid it.
So what are you guys looking at? I know today it's a pretty volatile capital markets and real estate environment here in the US and elsewhere, but what are you guys looking at these days or like on the horizon?
Well, about 2.5 years ago, 3 years ago, when there was a lot of money being injected into the economy, towards the tail end of COVID. We kind of foresaw, and not only us, everybody saw that inflation was probably coming back, and the rates were starting to climb here. And that's challenging. We know that everybody that's listening, if they're in real estate, know that this is a challenging environment with the high rates. So we really were very interested in a thesis that we picked up. It's not our term, but I think I've mentioned it to you before, Matt, and we love the term dequity. So we were trying to find how to participate in real estate deals, finding the correct vehicles with the correct guarantees that could provide, again, an adequate return over an acceptable time frame. And, there we ended up right now we've been working hard on a strategy that is basically lot warehousing with some of the 50 largest developers in the US, where that involves some development, and some of these lots we just buy and hold and set up a financial structure. And there again, it's truly dequity, because even though we participate in equity, and without to go too deep down that rabbit hole, we actually do own the assets, and we sell them back on a predetermined calendar. And that's, we started doing that 2.5 years ago on a deal by deal basis. Thankfully, we've been successful. And over the last 4 or 5 months, we've been working hard with our US partners, starting to raise money for a fund structure that is exclusively dedicated to that strategy. And we've been happy to be able to raise the equity we want for the first round, and are looking to do a second round somewhere thereabouts November, December, for this strategy. And there, just to give the audience an idea of where we're at, we're at approximately between a 12 and a 14% IRR, with about a 4 or 5 year expected time frame, with very significant equity back starting year one. So you start getting some of your money back. And our investors in this volatile environment appreciate that as a good alternative to other investments. And again, we put all the buffet in front of our guys. We don't pretend to not offer other opportunities, but we've been going hard at this right now. And with rates doing what they're doing, all this is taken into consideration into the financial model before we acquire or before we start the strategy. So it's a good protection for that. I don't know, Gabriel, if you'd like.
Yeah, well, and maybe Gabriel, I'll direct this one at you, but how do you guys on the investor side of the equation? My understanding, most of the investors are based in Mexico, right? So they're foreign to the US. How has it been for you guys or your sponsor partners in terms of dealing with the international rules around investors coming in, investing in the United States? Are they US citizens? Do they file US tax returns? Do you have to deal with some of the Reg S and the various things that you have to do when you have foreign investors? Or maybe touch upon that a little bit.
Well, yeah, it's good that you ask, Matt. First, just to clarify, all the investments that we do and the sponsors that we choose to participate with, all the investments partly come from Mexican investors that we onboard, and US investors from their part. So we're not just the equity participants in an asset class. When we do a partnership with a sponsor or operator of a specific asset class, like, for example, multifamily, they bring their own investors. We complement with Mexican investors. But and that's very interesting that you do ask. When we say Mexican investors, obviously that's part of our value in onboarding these investors. All investors, as Pedro was saying, are by invitation, are within the business community and the family offices we vet and know in Mexico personally. And Sorry?
Yeah. No, keep going.
Oh, and they invest, they invest through all called established companies in the US. All our investors for practical purposes are US investors. They invest through their C Corp in the US, and they pay taxes accordingly to their status. Most of them are C Corps, check the box corporations that participate directly into the vehicles in which we do our investments with our sponsors.
Yeah, so then you guys are coordinating all that part of it with whoever your sponsors are in terms of the investment side, because obviously there's a lot of rules and compliance and things that have to be, make sure you got your I's dotted and your T's crossed, right? So
yes, exactly. KYC is a very important issue for us. That's why we invite or we onboard investors only by invitation, and we know those investors. And we help them. In some cases, most of them are very high net worth individuals or family office that already have their structures very well established in the US with their advisors. But some of them, we do help some other investors to approach the tax advisors and the accountants that would help them establish that structure the best way or more efficient way. We think we have learned to participate in real estate in the US.
yeah, and so as we get here to the bottom of the hour, if anybody has any questions, if you want to go ahead and type those in, happy to have a little Q&A here at the end. So feel free to type that in. So guys, as you look forward here, it sounds like, you've been in the US for the last 10, 12 years very successfully. Seems like things have grown. Are you looking at, I know we talked a little bit about some of the deals. You're generally looking at what time frame? You said 4 or 5 years, Pedro, on the one strategy on the lots. Is that a typical time frame? So you go in full cycle on a lot of these deals, and where are you guys at these days, just in terms of your appetite for capital deployment?
Well, we're always on the searching for next strategies where we want to participate, and we talk to a lot of very, very capable, very smart sponsors over all the spectrum for real estate. Honestly, we are continue trying to identify correct sponsorships with middle market operators that we feel we can grow for a relationship, anywhere from 7 to 10 years, and that they have a pipeline that would allow us to be able to create that partnership. It's difficult for us. I mean, we get great deals that come to us on a deal by deal basis, 3 million there, 2 million there, 5 million here. And there, sometimes we look at the numbers and to be honest, sometimes we do write that check, but most of the time what we're trying to identify is that correct fit with a partnership. We usually will do a couple of deal by deal deals to start the ball rolling and get a better sense of how we each other work. And then we move forward to trying to deploy together a larger amount of equity. So as of now, like you mentioned, we are very, very deep into this first round of equity raise for this fund. And then we're probably going to continue that from here to November. But we never stop, Matt, actually analyzing different strategies and trying to find value and also the fit. Like, it's very important to us that the people that we work with, we can, we have a good fit together as to what we expect and they expect, for us going forward.
To try to answer, Matt, that more specifically, as you know, we participate from equity positions, direct ownership on properties, being that multifamily or retail or educational centers, and we cover the whole spectrum because we do also have a lending fund in which we participate through debt. And as you know, the spectrum in equity in those properties that we own, it's usually a hold of 5 to 10 years. Most of those investments, which we started about 10 years ago, have divested. We took the opportunity in 2021, 2022, when rates were still low, to have a very successful exit strategy in half of our multifamily portfolio, which we sold, which very attractive returns. And we have allocated that into a more conservative structure, either on opportunities, both in multifamily and retail for preferred equity, or we have participated in the lending space, and now currently in an in-between, which we call debt equity, which is the warehousing of this residential land, in which we own the land, but it is already established the payment and the price structure, so as the investment actually behaves more like a debt, although we are the owners of that real estate. So it's kind of an in-between. We find that investors have seen very attractive in a risk-return basis, and also on the certainty that right now the market reflects, which is when would you sell that property, at what price, and to whom, right? And in this structure, we have that predefined since the start of the investment. So that gives clarity to investors and complements the investments made by our investors in the other asset classes.
Yeah, so it sounds like you guys are always looking for new and do things that make sense, right? Sponsors that have the right stuff to be able to combined with the right strategy and the right infrastructure. So that's always looking for new stuff. I think people out there, and we'll here at the end, we'll give you some contact information. Feel free to reach out to Pedro and Gabriel. And yeah, I mean, having known these guys for a while, I know that you guys have a good thing going on. So we have one question, and you touched upon a little bit, Pedro, but like your typical investment size that you're looking for, you said it's a few $1 million, but it's more programmatic than that, right? So do you have kind of an idea of what deal sizes and even markets and areas that you guys are interested in?
I think, deal size, frankly, if it's a good question, it's an excellent question, Matt, and a good way to look at it. I think most people will relate. It'll depend a little bit on the asset class. For example, on the neighborhood shopping community centers, maybe the average ticket is 15 to 20 million on a
total capitalization.
Total. And then if you do multifamily with what's happened now, as you know, for replacement costs and deals, probably that goes up to 35 to 50. We're not looking for the $500 million deals. That's not us. We're actually more, again, in something that you've explored professionally, which is that middle market, right? And we love to live there. Now, that being said, let me go back to our strategy today with the lots. And the first deal we ever did on this was with a nationwide home developer. And, we did about 200 lots for them in Dallas, Texas, in Fort Worth, Texas, I'm sorry. And that deal was a total equity check of like $4.5 million for the whole deal. For the equity part of that. And there was some debt on that. So that the strategy sometimes accepts or doesn't need a very big check. However, that same developer is now doing 600 lots, because these are individual lots that have been pre-sold to them, with a mutually established calendar. So in that deal, that ticket went up to about $14.5 million for equity on day one. So I think to answer your question, we love to live between 10 and 30 is a good place to live for equity checks, right? But sometimes they're a little bigger, sometimes they're a little smaller, and it'll depend on the deal for sure.
Yeah. How about markets? I know you guys have done quite a bit in Texas. Is there markets you just flat out are not interested in, or that you're particularly focused on?
Go ahead. Go ahead.
Historically, we have actually invested in more than 35 states in the US. We're very focused on, as everybody knows, for the past 10 years, Sunbelt states have had a very good run. We're always analyzing not only obviously state basis, we still remain our investments are focused on the Sunbelt states. We don't do coastal Although we do Florida, we don't do Miami. We haven't done that areas. Obviously, East Coast, West Coast, California, we don't participate. Mostly on the South, Texas, North Carolina, South Carolina. We go all the way up to Illinois. But we're constantly open to new markets and evaluating the existing markets, because this is a supply demand business in which we have to have fully analyzed in the specific area in which we are to participate. How is that supply demand demographics? We do all the analysis to assess if that area is still attractive in the medium and long term, or we should focus our investments on somewhere else.
Yeah.
I'll mention that some of the, 100% on Gabriel, and we are, one of the things that we've seen and our analysis shows is that some markets that we would have overlooked 5 or 10 years ago, we wouldn't have, looked at them, Mississippi and some of the other southern states and then some northern states, not all the way in the Northeast, but have or are very, very interesting markets for different reasons. Some of them have a very high average income that allows for, a little bit higher returns on or higher rent payments on multifamily, for example. And then others have been sub-utilized or sub-exploited. And so there's a market there in some of these secondary markets in other states. However, that would be a very small percentage of what we're doing. We know markets where we've operated. We know markets where we're not putting any more money in, and we know markets where we're looking for more deals to put money in. So, again, that's part of our job, working with the sponsors to identify the target areas for our strategies.
Yeah. Well, guys, if some people want to reach out to you guys, how do they get a hold of you?
I think, I see an email there, and that's a great place to start. That's my personal email, and there's Gabriel's too. So you've got us there. Happy to connect. We've actually have talked to other people that are part of the Verivest environment, and we talk to all kinds of sponsors all the time, guys. If you have questions or would like to talk more about what we do, if you'd like to present some of what you're doing and think there might be a possibility of working together going forward, happy to connect and trying to explore that further.
Well, we appreciate you guys coming on. If anybody out there wants to, I'm happy to make the connection as well. So feel free to reach out to me. Guys, it's fascinating to meet people that have access to capital from other countries that are bringing them in and active in the United States. I haven't seen too many folks doing it in the middle market as successfully as you guys have. So I'm glad you guys were able to make it on the show and share some of what you guys are doing with our audience. So thanks, guys, for being here.
Matt,
thank you for having us, Matt.
Everybody in the audience, Kylie, everybody, thank you so very much and have a great, great day.
Awesome. Thanks, guys. And everybody else, we'll have another one coming up here next month. I think you'll find fascinating. So thanks again for joining us, and we'll talk to you guys soon. Bye-bye.
Be well. Bye.